A significant increase in real estate firms raising funds from retail investors via NCDs or non-convertible debentures in the recent past has been seen. Are these investments safe for the investors though? Oinitum tries to answer this question with the help of experts.
Tough times for the realty space. Banks are wary of lending, institutional investors are being cautious, and PE funds are being choosy in investing. Left with very few options and a liquidity crunch staring at the face, real estate firms are taking the NCD route in a big way despite ratings agencies downgrading some past issues.
Yes, there has been in the past couple of years an increase in interest, primarily because of lack of other investment opportunities thanks to the equity markets being the way they are. Year on year for the last 2 years, I think there would be a 20-25% increase in the demand that's coming from customers for such products.
But given the market conditions and the high rate of borrowing for the debt instrument, which is hovering around the 28% mark, inclusive of underwriter and brokerage charges, are NCDs the best option for the sector?
Any number, whatever the size, raises concerns in case there is, for example, you have a concern that why are such issuances being made, do they represent a risk? So we should look at these kinds of issues also, but I think there is a justification where an issuer is not able to raise money from elsewhere, either through debt or equity, and is therefore forced to offer a higher interest rate.
So this is really not long-term capital. For long-term capital, banks is the best recourse. But being short-term, it is relatively safe, and a lot depends on how the developers' projects fare. So typically, developers are using this till they get their approvals and get access to a cheaper form of funding. So as long as it's short-term and the projects are throwing cash flows, it is relatively safe.
However, the cost of borrowing is key, and also a lot depends on the performance of the micro markets, say experts.
The overall cost for developers in the real estate NCDs that we look at is 21 to 24%. And that is a pretty decent number for developers to run with. Because see, the whole thesis of raising funds at 21 to 24% is that the developers feel they can get an IRR of 30 to 40% on the completed project. And that's why it makes sense for them to do that. But if we are running at 28 to 30% cost, then it will be cutting it a bit too fine. And these are the NCDs which might get into trouble.
In 2013, the housing and construction sector has raised over 6,600 crore rupees through the NCD route as compared to around 9,600 crores in 2012. And this includes some of the top players of the industry. While DLF raised 750 crores through private placements in April this year, Indiabulls Real Estate raised 500 crores through the same route. Another realty major, Tata Housing, raised 400 crores in 2 tranches this year. Mahindra Lifespace Developers, the realty arm of the Mahindra Group, raised 500 crores, while Mumbai-based Marathon Realty raised 190 crores earlier this year through the NCD route. Political and economic instability has cost the realty sector very dearly. While the sector waits for a turnaround and the markets to pick up, experts feel NCDs are likely to continue as the attractive debt instrument for another 6 to 9 months. In New Delhi with Nidhi Rai and Oinitam Ojha, Vasudha Sharma for NDTV.
We've got with us Harsh Rungta, CEO of ApnaPaisa.com, and Surya Bhatia, Managing Partner, Asset Managers, to decode this dilemma a little bit more, because we've heard both sides of the story in this main story that Oinitum has done. Gentlemen, I think first, Harsh, over to you. Tell me, I mean, definitely 18% doesn't at the face of it look like a very large number on the NCD, but if you add to the underwriter cost and if you add to the brokerage, the cost of funds for the developer would probably be in excess of 25%, and that's expensive, isn't it, Harsh?
Yeah, absolutely. I mean, 18% is nothing to laugh about in any case, and whether it will go up to as much as 25%, we don't know. But clearly, I think with those kind of returns, when you get high returns, high risk is a necessary corollary to that. There is no way you can get high returns without high risk, and obviously it is because of the high risk that you are getting as an investor, you are getting these returns. I mean,
Okay.
let's look at what these markets replace. I mean, typically the developers were raising funds from private financiers who knew them, who had developed a relationship with them, and therefore were in a better position to assess those risks, and they were giving at much higher rates than even this, or around the 24-25% mark that you mentioned. It worked well for them because they could assess the risks given the long standing relationship, plus also the fact that they watched that risk with a hawk's eye. But that is not true of a retail investor. So I would urge super caution before you look at a investment in an NCD like this.
So yeah, is there a worry there, you know, because these products are very aggressively getting hawked to retail investors? Is there a worry that, you know, if you're not an extremely high net worth investor, stay away from these assets?
The pitfalls are too much vis-a-vis the interest rate which you actually earn on them. The earnings on these, as rightly said, is 18 to 19%, and but really matters is what the negatives are.
Okay.
You are getting NCDs at 19%, which are taxable by nature. So what do you get in hand? That's the first thing to see. Second thing is,
What do you get in hand?
I get 30% if I'm an HNI investor. By default, I come in a 30% tax bracket. So
Okay.
effectively, what I get in hand is 15%, more
All
or
right.
less.
Which
to
today
get-
does seem mouth-watering.
It's great, huh? No other asset class matches this. That's why the pitfall lies. Anyone offering me a 15% post-tax return, I need to just open my eye and see why someone is offering me this kind of return.
Okay.
So, why are they first offering me, huh? That's the first thing I need to answer. Because banks are not very comfortable now lending this money to a lot of developers. They're not very comfortable doing it. So therefore, they see a very easy route going to the HNI investors, or even going to, let's say, small companies, corporates, which have money easily available right now with them, and they can invest in large quantities. That's why the minimum ticket is not less than 5 lakhs.
Are they selling very well? Are they able to garner a lot of money? These
We don't
real
have
estate
data points
debentures?
on this because it's not a very developed market. But typically, I think 3,000 to 4,000 crores should be the market for this.
Harsh, is it, I mean, it's not new. NCDs by real estate players have also been floated in the past. Has there been any big worry in terms of any big defaults, or do you think that this time around, because the economy is looking much worse and developers are looking more distressed, the risks have gone up?
Clearly the risks have gone up. I mean, and it is because of the lack of institutional alternatives or even the private financiers that this market is being tapped. And I think the worrying thing, you mentioned how this is being marketed, and this now is being marketed through the wealth management arms of the banks and the NBFCs. And I think that really is, and you now having people who invest 5 lakhs, 10 lakhs, whose total debt investment portfolios might be 50 lakhs or 100 lakhs. Now for them to invest in this is bit risky. As long as you know you have a couple of $1 million in debt, out of which you put in 10, 15, 20, 30 lakhs, I think those people are better able to assess the risk, as well as also able to take a knock that might possibly come. But somebody who's put 20% or 25% of his debt portfolio in one single NCD lured by the high interest rate is taking a real big risk. You are absolutely right. The risks have increased dramatically. I mean, your show itself talks about how projects are getting delayed, and because of the tightening screws by RBI, I think access to bank financing has become extremely tight. I think it's a very risky scenario.
Okay, risky proposition. And you know what worries me, Surya, is what Harsh just mentioned. It's being hawked aggressively by wealth managers or banks. Remember the ULIP time when those products were being hawked as well? Okay, there was a lot of mis-selling happening. Here there's no mis-selling happening. You do know it's an NCD. It will give you those kind of returns.
But you look at the disclaimers.
Of course, the company has to survive that period.
But you look at the disclaimers which these wealth managers gave. I was just reading one of the disclaimers. They just discount everything for themselves.
Okay.
So if I am a wealth manager selling a product, at least I need to have some onus on myself. If I
Right.
go ahead and sell you a product,
So what are those disclaimers?
they just strike away from all the responsibilities.
Okay.
That we have not done any due diligence on them. So then why do I come and sell you? It's not fair. And there
okay.
have been defaults happening.
Samir is smiling. I'm sure he has a point to make. Samir?
I actually have a slightly contrarian view here.
All right. We'd love to
You
hear
know,
a contrary view because there are people buying into that instrument.
I think this is the biggest market right now. And in some respects, if you're a savvy investor, it's one of the safest markets. And I'll give you the reasons why.
Okay.
I interact with all the private equity funds all the time. This is all they're doing. You know, and their money is at risk as well. I'll tell you why it is slightly safe, and
They
you
can
have to do a
afford to
little
lose.
bit.
They raise money from investors
absolutely
and then
not.
they lose it.
Absolutely not. Absolutely not. I disagree with you here. So I had a detailed chat with some private equity funds as to what they were really doing. So you know what they're doing really? They're taking a successful project in the as a collateral, taking 2x of that as the collateral and not a single x. So you compare this to housing finance or bank finance, where they get a single x of collateral. Here they're taking
Those
double
are
the
PE
collateral.
investors. What is
But
against this NCD?
let
What
me
is the
come to you.
realistic?
These are NCD deals that are happening.
Okay.
I'm talking about NCD deals. I'm not talking about equity deals here. This is collateral happening there. Then what they're doing is they're taking the cash flows of the project. In the cash flows of the project should have done 40 to 50% of sales and 30 to 40% of sales monies for each flat should have been recovered.
Okay.
So in my personal opinion, if you go with a reasonably reputed developer, this will be the last asset that the
Samir,
developer will default on.
list out 10 reasonably reputed developers that you would stake your money on.
On an NCD?
On an NCD.
Okay, on an NCD, I may want to risk my money on developers who I would want to risk my money on SPVs where projects are doing well. Yeah. And I would be smart enough. So I said you have to be a smart enough investor to make that 15% return. For that, you have to do some homework. You can't be blind about it.
Okay. Harsh, do you think you can be smart enough and understand, okay, this money is being used for a certain project, which is at an SPV level where PE investors have already decided that double the assets have to be put as collateral. So, hey, guess what? My risks are lower.
Well, let me just put it this way, Manisha, if I was that smart that I could do that kind of due diligence, as obviously Samir obviously can, if I can do that kind of due diligence, I will buy that project. Why would I lend it? Then in that project itself, I would earn far more as a real estate investment than I would as an NCD. If that project is really safe, then the risk premium that is there in the pricing will get me the returns that I want. Why would I put an NCD on it?
Fantastic argument. Why?
They're not raising equity in that project. They're only
No,
borrowing.
but he's saying you can actually buy a flat in that project.
But
Only the ticket
question
size
is
would be
that's
much
a
higher.
totally different product, asset class. Totally
Absolutely,
different. That
absolutely.
will require you to hold on to that asset for 5-6
But
years.
he's saying if it's so mouth-watering, if the assets are so
but you're taking
mouth-watering,
the
then I
risk
would
on the
take
market. Here is a pure debt. You
Okay,
want an
Harsh, go in. I love these kind of debates. Harsh, your point.
Manisha, it is not, I beg to differ, it is not a different asset class. When you are putting NCD in a real estate, it is not debt, you are investing in real estate. I think that is the crux of my argument, and you might as well then get the returns of nurturing that risk. I mean, why take a fixed return for nurturing a huge risk? You might as well take the full return.
Sir, with
Of
all
course,
due
your ticket
respect,
size will be far
today
higher.
I'd like to take the debt over the equity risk in today's markets because the prices have run up so much. If somebody offers me a 15% assured return on real estate, I'd rather take that than take an equity risk in this market. And that's all we've been saying all along over here.
Okay, Surya, last point to make, and we should wrap out this discussion. I'm sure the viewers out there are very smart to understand and make something of this debate.
See, first of all, this is not meant for retail investors for sure. But he also rightly mentioned, Harsh also mentioned,
High
it
net
needs to
worth
be meant
investors
for HNIs who
who've got a lot of
first
money.
read what they are going into. They need to be aware about the pitfalls, about the advantages, about the interest which they earn. But at the same time, they should be aware what they are buying. You have to look at a debt equity ratio. The companies which defaulted were at 0.5, 0.6x of the debt equity. Even they defaulted. So therefore, the key is the sales have to happen. If the sales do not happen, they cannot service the interest, they cannot service the principal repayment for sure. So sales is a critical part. Till the time that is going on, you will service your
Okay,
debt.
so I think you've just pretty much summed it up that this asset will be as risky as the sales of the project are, and if looking at the current slowness in the environment, the risks definitely of investing in a non-convertible debenture of a real estate company which is offering you mouth-watering returns of 18 to 19% have gone up tremendously. So before you buy into or jump onto that product, if your wealth manager is hawking it, please look at the rationale or logic of why you're buying into it. Harsh Shungta, Surya Bhatia, thank you gentlemen for taking this discussion and debate, and of course giving us some answers on whether one should be looking at this product or not. Okay, we'll move back to Q&As where Sameer doesn't have to discuss or debate anything.